Are you tired of staring at those car insurance bills, scratching your head, wondering why the rates keep going up, even though you haven't been in any accidents or anything like that? Do you find yourself asking, being frustrated, is there anything you can do about that? Well, you're in the right place, and I'm going to give you some of the simple solutions that can save you thousands of dollars, even enough to buy a new car in the future, if you do it right. Hey, y'all, welcome to the Money Mindset channel. Some of y'all know me as Mr. Mindset, and I'm thrilled to embark on this journey with you towards some financial empowerment. So, subscribe and follow this channel, and you will surely get it. Today, I want to discuss common sense and practical strategies that can put you some money back in your pockets, regardless of the car that you drive. You see, as your car ages and you've paid it off, you might find yourself overpaying for insurance and not realizing it. Unfortunately, this is something that affects all of us, no matter the car you drive or the number of years that you have safe driving under your belt. Let's look at one mindset and method to eliminate unnecessary money spent on car insurance. So hang in there and let me show you how it's done. It's all about mindset and how you look at things. Here's a scenario, but keep in mind it doesn't matter what the situation is. Understanding this idea and using common sense methods will work for anyone. Now, picture you buying a 2010 Toyota Camry, which originally cost around $21,195. You would have had to get full coverage insurance for the bank's sake for sure, if nothing else. Well, by 2015 or 16, you would have probably paid that car off and then be free from the obligation of carrying full coverage. So far, you had been paying around $120 a month or about $1,440 a year for that coverage, totaling about $7,200 insurance in the time that until you paid it off. Now, most people would tend to continue keeping that full coverage. They tend to continue paying the same amount for the full coverage just in case their car gets stolen or gets totaled or something like that. But they don't realize changing from full coverage to full liability insurance probably becomes the best option once the car is paid off in full. Most importantly, people don't deeply consider that the insurance company is only ever going to pay what the car is actually worth at the time a claim is filed. For example, in 2016, that same Camry was worth around 10,600 to 12,700 at the extreme. So far, you have paid about 7,200 of that insurance alone. If the car was total, you would have netted about $5,500 in the settlement, if you understand what I'm saying. In other words, that's about 12,700 minus the 7,200 that you've already paid in insurance, and you would then need to get another car with that money. Well, you would at best have netted a down payment of about $5,500 to go back in debt with a new car with more wasted full coverage, or enough to get a used car with that cash. But say there were no accidents, and let's now add 5 years to that. It is now 2021. A 2010 Toyota Camry in 2021 would be worth approximately between 5,300 to 7,400 at best. And here's the problem now. By then, you have spent about $14,400 in full coverage insurance. Yet the most you would ever get if that car was totaled is $7,400 on a good day. That doesn't make financial sense. Well, what should you do instead, Mr. Mindset? Well, reduce your monthly insurance cost to approximately $60 a month with full liability insurance, because this is where the real potential lies. How should you do it then? Well, partner, drop the full coverage as soon as you see the worth of your car is way less than what you have paid in insurance premiums. Take that extra $60 a month or the difference between the insurance rates and direct it into a self-insurance fund. Let's examine what this shift could mean for your financial future. Every 5 years, embracing this change, you would save a projected $3,600. Let's broaden that perspective. By continuing to keep the full coverage, you'd face an additional, say, $7,200 in insurance every 5 years, culminating in $14,400 spent in insurance by 2021 with no returns. All that money is paid for insurance with nothing to show for it, assuming you had no accidents or stuff like that, though. Let's fix it. First things first, you should head to your bank account, like Wells Fargo or a trusted financial institution, and set up what I call the self insurance fund. Then automate your payments into that account. Those will be the payments that you were making for your full coverage insurance, the part that you're taking out. Automate that into your bank account. Here's where the magic happens. Let's take that extra $60, the difference between your original rate of 120 and the new rate of 60 for liability insurance, and have it automatically deposited into the special account. Over time, this method can be a game changer. By redirecting that $60 a month in your self insurance fund every 5 years, you'll accumulate $3,600. That's $3,600 you would have otherwise spent without anything tangible to show for it. By 2021, you would have saved $7,200 in cash. Now, do you realize you would have had the same amount of money in hand as if you had kept paying the insurance company $14,400 all that time? And the funny thing is, your car actually would have had the same coverage the whole time. What? What do you mean? Yeah, because if you would have dropped the full coverage and someone else totaled your car in an accident, then their insurance by law would have to cover the cost of your car. If you totaled your car, you would just take the money you've been saving and make a choice to buy used or make a down payment on a new one. If you totaled someone else's car, then your liability policy would cover the damage and the injuries based on the coverage limits that you chose. I will say it only gets tricky if you total your own car in 2016, the day you drop the full coverage, and you haven't saved any money yet. But who's that goofy? Hey, to sum it up, no matter what you're thinking, drop the full coverage at some point after paying off the car. Just know the value of your car at the time and do the math. As long as you keep saving the extra money and stay out of accidents, at some point you might have enough saved for your next new car, if you think about it carefully. Oh, by the way, insurance companies already know this, and that's why they will never voluntarily tell you this. And if you ask them, they're going to probably try to psych you into believing it's best to keep the full coverage somehow. And I hope you see why they might do it. This isn't just about a single car or a specific year. It's about financial control regardless of your vehicle. By utilizing this strategy, you're not just cutting costs, you're building your financial stability. Now, listen, I know some of you think that it looks a little cheesy not to have full coverage on your car. That's some type of stigma that people have, like, man, you don't have full coverage. Please don't let that make a fool out of you. It's all about the money, man. Math does not lie. Now, think of this as a blueprint, a method you can apply to any car or any situation. Let's make money work for our dreams, and this is what you'll get by sticking with this channel. Leave your questions or comments below and subscribe. Thank y'all for making it to the end. I'm Mr. Mindset on the Money Mindset channel. And visit my other channel, the Music Mindset channel, and stuff like that. We're trying to help ourselves stay financially stable in these tough times. The things I'm going to be bringing you on this channel are really going to be the things that matter to the average person. Now, you rich folks, yeah, whatever.